Home ownership used to be a natural next step for people in their late 20s and early 30s. But as they stand on the sidelines, a new kind of investor is stepping in, but not the one you might think.
We're able to be nimble like a small investor, but not be with the red tape and bureaucracy of a large REIT or a larger, like, for example, a Blackstone.
Rajan Bhatt is the co-founder and president of Strand Capital, a private equity firm. But he started out as a physician.
I've always been more entrepreneurial, going back 2 decades or more. Building a company with my wife, Spectrum Dermatology, which I then sold in 2021, and building all our medical office and owning our real estate at that point, and also having multifamily, and then fast forwarding and getting involved in industrial land development, and obviously being in a single family, it has been in the heart of me always for 20 years.
Bhatt's fund specializes in renting out single-family homes, a trend that's been on the rise because buying the house you live in has become increasingly difficult. About 2/3 of Americans own their own homes, up from the early 1990s, but well below the peak of over 69% just before the great financial crisis.
In an environment today where the affordability index is constrained, you have interest rates that are high, you have economic uncertainty. You have the average American can't afford housing at these levels in today's environment.
When there is a market imbalance, as there was in 2009, investors typically step in to address it. And back then, it was the big institutions like Blackstone.
You would expect capital to flow into these markets, but if the cost is prohibitive, nobody's going to expose capital to higher than normal costs. And so I think right now everyone is waiting to see what happens.
Nancy Wallace is a professor at the Berkeley Haas School of Business and chairs the real estate group there.
You have to remember the origins of the single-family rental by large corporation or large fund purchases. Those were heavily subsidized by Fannie and Freddie mortgages that went to help these corporations buy the homes. So they actually financed that. That was a one-time thing. It was very helpful for their initial growth. And then it was taking advantage of the out-migration from the coastal states, especially during COVID, into these markets that were heavily single-family for-rent markets, especially in Georgia, Atlanta, Charlotte, Tampa, Florida. But right now, unless things change in terms of tariffs and the cost of construction, I wouldn't expect to see huge growth in single-family for rent by very large players.
The role of investors in home ownership is particularly pronounced in the Sun Belt in California. Investors purchased nearly 1/3 of homes sold in Miami in the fourth quarter of 2022 and about 1/4 in Atlanta. In California, investors own more than 50% of homes in 5 counties.
It has to do with demographics and what preferences are for home ownership. And it does appear that there are some shifts in terms of, yes, people are interested in having a single-family home, but with 2 homeowner working couples, which is largely the segment of the economy that's interested in these homes, they're not interested in home maintenance. They're not interested in the other things that break down, that they would prefer to call someone to have them come and fix it.
15 years ago, it was the big funds that stepped in to buy single-family houses and rent them out. But recently, they have pulled back as the smaller investors step into that role. In the first half of this year, small investors made up about 25% of single-family home purchases. Large investors accounted for only about 5%.
Builders are constrained. They are constrained, the interest rates are high. The builders are negotiating with small investors, whether it be 5, 10, or 20 homes. They are offering incentives on financing. They're offering deals on homes.
The current investor-owned housing trend began back during the 2007 housing bubble.
In the Great Recession, I just came into office, right? So I had graduated law school, been 8 years. I couldn't even afford a home.
Dina Neal is a state senator in Nevada who has seen the housing market transform since the great financial crisis.
In the Great Recession, homes were about $350,000, and it was a 1965 home with no renovation. Now you have a brand new home that's about $450,000 that no one can afford. And you have older homes that are selling for about the same amount, $350,000, and they were built in the 60s. The average income of a Nevadan is around $50,000. $50,000 is not enough to afford a house in this market. And so typically the housing market has jumped, so you can't even find anything for $250,000. I know specifically I know pharmacists that are making $170K, and they can't afford a home in this market.
Nevada is one of the hot spots for investors. Institutional investors' market share in residential real estate is up 8 percentage points in 3 years there. In Senator Neal's constituency of North Las Vegas, that number is even higher.
They're 27% of the Vegas market. It's significant and it's grown. They are now purchasing entire streets. They're building entire neighborhoods for rent. And so this is going on in Henderson, this is going on in North Las Vegas, it's across the valley. And I think it's significant because it's not creating home ownership, it's creating renters, which is different.
Senator Neal introduced legislation to cap the number of homes owned by investors at 100, but the measure recently failed.
Literally when I left session, it was the national story where a corporate investor purchased 115 homes in one day. And this was a question that came up to me during the session. As families or as individuals, we're also trying to expand our own wealth, right? So 15 or 20 houses to me is still a mom and pop, right? There's still a smaller investor that is saying, you know what, I'm trying to expand my own generational wealth, but it's not to the greatest extent of 100 homes. And there was a conversation around, are you trying to lock me out of my own ability to operate as a small capitalist? And I had to say, no. But there's a fine line in gaining wealth and greed.
But Wallace thinks the size of investors in the housing market is exactly what is different this time around.
How is this time different from what we saw in 2006, 2007, where we did have some mom and pops coming in, I think often to flip the homes rather than to hold them and rent them?
I think that's exactly what the difference is. Although there are, house prices are definitely rising in California again, we're not seeing the flipper. At least we think we're not, but that is a hard phenomenon to measure. Fannie and Freddie, as you know, in 2023, changed their policies in terms of qualifying for investor loans and getting them and being eligible for Fannie and Freddie securitization. So the kind of pricing that you'd get from a Fannie and Freddie securitized loans. So now under their rules, basically the loan-to-value ratios are identical if you're an investor or you're buying it for ownership where you will live in the property.
As if the story of single-family home investment wasn't complicated enough, there's now a new potential threat on the horizon. Reports are that the Trump administration hopes to spin off government-sponsored enterprises Fannie Mae and Freddie Mac, which have been under government control since the great financial crisis.
So right now, if you buy a Fannie Mae mortgage-backed security or a Ginnie Mae mortgage-backed security, you are guaranteed against default risk. Who provides that guarantee? The U.S. government right now through the conservatorship, the protections we have in place that Fannie, Freddie, and Ginnie cannot fail. If we privatize Fannie and Freddie and make it semi-private, who is going to provide that guarantee? Where are we going to find sufficient capital? We're talking about markets that are $14 trillion large. Where are we going to find the private capital to support those markets, especially without very careful analysis? And that has not happened by the Federal Housing Finance Administration to try to figure out how we're going to do this. So I think anything that's poorly thought out happens very rapidly, is a recipe for disaster on this very thorny problem that we have struggled with now for years and failed. And largely, I think the pressure on this is very active shareholders, especially Ackerman and Paulson, two very large shareholders of Fannie and Freddie paper, especially Fannie paper, that want to monetize this paper. And I think making a decision to benefit two large shareholders is ridiculous if it could bring down the U.S. mortgage market.
The U.S. housing market has been through the ringer, from the great financial crisis to inflation driving up construction costs to rising mortgage rates. Privatization of Fannie and Freddie could upset the apple cart once again. And whoever stands to gain or lose, investors tend not to like that kind of uncertainty.